Hi, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets, and my colleague, Victor. Hello, Victor.
Hello, Fawad. Looking forward to a very dynamic session.
Indeed, the markets have been very volatile last few days. Sell-off started on Friday in Europe, and on Monday we saw a big sell-off for technology stocks in the US. And today we're seeing some further follow-through in the selling. The Turkish Lira has slumped another 10% on the day. It's all happening, guys. We'll get into all of that in a minute or so.
But first, let's go through the mandatory disclaimer, which is that these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. And Think Markets shall not be responsible for any loss that you incur either directly or indirectly arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors.
Thank you, Victor. So guys, for those of you who are regular here, this webinar happens every Tuesday, 11:30 London time. We talk mainly technical analysis, but we touch on fundamentals as well. The markets we cover are major fixed pairs, gold indices, but sometimes we cover other types of markets as well, cryptos and minor effects, etc. So for those of you who are watching live, please make sure you ask us questions in the questions and answer box. For those of you who are watching a recording of this, please consider joining us live next time so that we can make this webinar even more interactive. Now then, I don't know where to start. Everything has been moving quite sharply in recent times. I mean, I was just looking at the Turkish Lira because I saw a headline coming through that the Turkish Lira has slumped another 10%. No
It's
surprises there.
Yeah.
It's unfortunately
Mr. Erdogan decided to just let go of the currency and completely fold in the face of rising interest rates globally, and the result is this. For any people that still think that the US dollar is, the days of the US dollar are numbered, guys, you're far off the mark. The US dollar is still the global reserve currency.
Yeah.
And if you want to be part of this global trade system, you'd rather defend your currency than let it fly, not fly, but falter.
Yeah.
Just as Mr. Erdogan did recently.
Yeah. So basically, Erdogan is the de facto leader of the CBRT, the Turkish Central Bank. He is anyone that has dared to raise interest rates to tame inflation in Turkey. Remember, inflation in Turkey is 20% almost. 20%.
Yeah.
That's huge. So when
if the official number is 20%, it's more than like 100% probably. Yeah. Considering the fact that our in the Western countries the official number is 5 or 6%, and we get 20. Yeah. So if we extrapolate that,
exactly. So when inflation rises rapidly, like 20%. The country's mandate is central bank's mandate is usually to control prices, yeah? And one of the ways they can do that is by tightening monetary policy, reducing the supply of money in the system. But in Turkey, Erdogan thinks that doesn't apply. Rather than increasing interest rates, he has been forcing the central bank to cut interest rates. And last week, the central bank cut interest rates 1% to 15%, and this started another big sell-off for the lira, causing the Turkish lira rates to rally to new record highs, and today it's gone another 10% higher. It's a massive move. It's becoming really dangerous at these levels, because it's going to impact
Yeah,
everyone in Turkey. Unfortunately,
and not only in Turkey, I would argue that it could start to impact at this point some European banks. Although professional, the professional opinions that I've asked for on this matter say that their exposure is probably hedged,
right?
In terms of currency. However, for example, a Spanish bank, BBVA, they have recently acquired, fully acquired. They used to own 50%, but now they own the whole.
100% of the bank.
They are the whole owners of Guarantee, which is one of the biggest banks in Turkey. Do we see some impact on indices? Yes. There is significant pressure, just as you were speaking about a breakout in the Spanish index. It faltered, and it's now trading back below the 200-day moving average, which is,
So for those of you who were here a couple of weeks ago, we were talking bullishly about the Spanish index because it had just come out of this consolidation zone and was holding above the 21-day exponential. And we say, for as long as it remains above that area, the path of least resistance is to the upside. But a number of things has happened since. Firstly, you've got that Spanish bank with the Turkish exposure that Victor was just talking about. That was the main reason the Spanish index was underperforming the rest of the European indices days before the sell-off started for other indices. So, for example, if you look at the the DAX, the DAX has been down for 1, 2, 3 days, right? Whereas the Spanish index, over the last 3 days, it's fallen, but not as much as the DAX. But look how it was already falling before the DAX had started to decline, and it was all to do with that with exposure to that bank. In addition, we've seen COVID cases surge across European countries. Austria has introduced lockdowns for the whole of the nation, surprising the market because previously they were calling for a partial lockdown for those who are not vaccinated. This has caused concerns to raise about demand in Europe, and that's why we've seen the euro weaken. We've seen commodities like crude oil weaken as well because of demand concerns, owing to the latest lockdowns, etc. And then in the US, on I think it was yesterday when Joe Biden, the U.S. president, announced that Jay Powell will remain chairman of the Federal Reserve, and that caused yields to spike yesterday. Yields, and that caused the dollar to go up because the market now expects the Fed to have a different role to how it has been behaving over the last couple of years to get the country out of pandemic.
I wouldn't say that's really the case because Jay Powell has been the head of the Fed over the past 5 years. No, sorry, not 5 or 4 years.
4 years, I think.
But anyway, the main theme here is that the alternative was Leo Brainard, who is very dovish person, probably the most dovish person on the committee at the Federal Reserve. Mm-hmm. So Biden chose not to elect her to chair the Fed. Yeah, and that basically played into the hands of bond bears who started selling off bonds and pushing rates higher because they expect that Powell, who's a Republican, is going to be much better for the dollar and for some sort of, at least attend some sort of tightening of monetary policy.
Well, they have to write
in the coming months.
Yeah, if you look at inflation in the US, it's at 5.4%. That's huge, right? Role of central bank is to control prices around the 2% target, and obviously to help support employment. But with inflation surging higher, the president of the US has spoken about inflation and how they're going to try to deal with it. So I reckon, whoever took charge of the Federal Reserve, they would had to kind of try and tame inflation anyhow. Anyway,
I just want to add here that that number was for September. We have actually 6.2%.
Is it 6.2? Sorry,
apparently, Google hasn't updated.
Google hasn't updated it.
But if you click on that chart,
this one,
I think it should be
6.2%.
6.2%. Yeah. So
accelerating.
Yeah, I mean, yesterday we had a huge number. I mean, the number was actually bad. It was a small number which is hugely important. Consumer confidence, US Michigan consumer confidence dropped down to 66.8, if I'm not mistaken.
Was it yesterday?
Or maybe it was Friday.
I think it was Friday. Matter. Yeah. Doesn't matter.
It was recently, and this consumer sentiment number is purely driven by rising prices. This is hitting confidence of consumers to spend money because everything is getting so much more expensive that they actually stop spending in fear that they might not be able to meet their obligations for the next month. Yeah,
and all of that, rising yields because of concerns of inflation. What happened yesterday? Yields broke out, the dollar rallied. Investors all of a sudden realized that, this could be bad news for technology stocks because, technology has been leading the global rally in the US since the pandemic, since the start of the pandemic. If you zoom out, you can see this little dip here. That was a huge drop back when it happened, right, in February of 2020.
Yeah.
But now, if you zoom out, it just looks like a minor correction.
Since then.
At least 3 times, yeah. So that looks, where we are at the moment, the markets are severely overbought. And if you look at technology companies, most of them have a very low dividend yields. Yeah. And with bond yields rising in the US, they're giving you 1.64% at the moment, and it's rising to 1.70, and soon we could be heading to 2%, right, for US bond yields. Some investors would be wondering whether it would make sense to keep buying stocks at these levels rather than buying bonds and earning a safe and a stable return from that. In terms of coupon payments. I think we will see rotation to that from yield-seeking investors. And for that reason, I think there's a risk that we may see the NASDAQ 100 sell off, or at least stage a correction, if not completely break down. And I think there's that move may have started now because we've broken the bullish trend line, the short-term bullish trend line. Yesterday, there was a big bearish engulfing candle on the daily chart. We failed to hold above the previous week's high. So what I would be interested in seeing today is, can we hold below the previous day's low? So right now we are testing we're below yesterday's low when it formed this bearish engulfing candle. It's possible that the index may go on to retest this level, which was Friday's low.
Yeah.
So once support, we broke below, it's possible we may retest that level and then sell off from there. But whatever happens, it's going to be very important. Maybe it's best to keep a close eye on the smaller time frames. And if I sync those levels on all my charts, I think this one is synced already. Yeah, these are the two levels that I'll be watching on the intraday basis. This will be the more important level. I'm just going to color that in red. For as long as we hold below that level, I think the path of least resistance would now be to the downside. So we could well see a continuation of the sell-off today, as concerns over tighter policy and higher interest rate, higher inflation, and all the other risks mount. Not to mention technical selling, momentum, and whatnot. So be very wary of a potential correction in the days ahead.
Some of the Christmas rally trend is actually in danger. Something that many traders are looking forward to. A rally around Christmas might not be. Santa may not be coming this year.
Santa may come. He may come later than usually is the case. So what might happen is we may see a sell-off in the next few days. And then maybe in December, the markets may stabilize and then rally again. Who knows?
The thing is that, what would be the reason for this sell-off to stop is for the Fed to blink. Yes. And somehow I don't see the Fed blinking at 6.2 inflation numbers.
Yeah.
It's just, it would be very high. Stupid.
Yeah.
It would be a dramatic hit to the confidence of the market in the Fed. So somehow I don't buy this. I feel like while we may still mark a new all-time high, we are very, very close to the end. And if you look at the most overheated market in recent year,
what's that?
Guess which one? Your favorite cryptocurrencies.
Yeah.
So if we look at that market, there is something very interesting going on there. And
they're all selling off.
Bitcoin is now.
It's trending low, isn't it? Lower lows and lower highs.
Turning bearish, yeah. It's that the trend is turning, and I guess we have next support, previous resistance around 52 or 53, something like that. Yeah. Yeah, 53,000. Yeah.
Just below.
We're just 3,000 above. We used to trade 13,000 higher 2 weeks ago. No?
Yeah.
So something has turned in this market dramatically.
Yeah.
I feel like it's just the beginning, and we could see way lower levels in cryptocurrencies, which nobody cares about. I have to add here, like the Fed is not gonna start riding to the rescue of cryptocurrency investors. Hello. The US government is not very fond of cryptocurrencies, and if there is a market that's most at risk from this from the current environment, it's that. And if the Fed has a mandate, is to discourage people to put their money in
cryptos,
such
risky,
questionable assets that are of questionable value in the views of the US government.
Indeed. So after forming this false breakout above this high, we've broken the support area that had led to that move up. So this shaded green area is now going to be resistance, which it has proven to be resistance. And for as long as Bitcoin remains below this shaded support resistance, rather, the path of least resistance would be to the downside. But if and when we break 60,000 on the upside, I think that would mark a turning point for Bitcoin. Could happen, but right now, as Victor mentioned, sentiment is quite bearish on low yielding or non-interest bearing assets like Bitcoin, Nasdaq, and gold, which brings me to your question, HH Hassan. Shouldn't gold be going up rather than down in this market environment? Well, you would think that would be the case, right? When stocks go down, usually gold would be going up. However, what's driving the sell-off is the bond yield, okay? So you have to understand what's driving the markets right now. It's inflation concerns, it's an interest rate, it's policy tightening concerns. And when yields are going up, as I mentioned, it's not necessarily good news for assets that pay no interest and cost money to store, like gold. That being said, gold is testing a very important level. Previously, I was expecting support to hold around this shaded region because that was a major resistance area that gold broke out
It
from.
didn't even stop yesterday.
And it didn't stop there.
Just went straight through.
It. I had that area. I got in and out of that within seconds. It triggered my limit buy before stopping me out very fast on that move down.
Yeah.
So right now, gold is coming to test the 200-day moving average, which is around the base of the previous breakout area. This area needs to hold now for gold bulls, right? If this area breaks, then I'm afraid that it looks like it's going to be all over them for gold bulls. This is the last area of defense in my view. Because it's the base of the breakout.
The battle of the bulge for gold traders.
Exactly. So a move below that zone, specifically below 1758, would negate any short-term bullish bias for gold. In which case,
there would be many stops below 1680, which should be a target, the target for the bear side.
Look at
and if you look at those stops, oh my god, that should be a very very dramatic move if we punch through there.
So you have this low here, you have these double lows, you have this low right here. Lots of stops, big stops would be resting below those levels. So what's this? Turkish Lira. This is gold, not Turkish Lira. Okay, those are the big kind of stop zones for gold bulls that maybe that's a target for the bears.
But break below 16, the 1650, 1680 area. This $30 there. No, I'm speaking lower.
Sorry, 1680.
First, obviously, it's the 1758. And 1780 area, but then a break below that would open, I feel, like 1500 or something like that.
So gold has also been
unlikely just a couple of weeks ago.
Exactly. Things change fast in the markets, and right now gold is being hammered because of the rising bond yields, because of concerns that central banks like the Fed will be tightening their policies faster, and also because of the strength of the dollar. If you look at the dollar, it's been breaking out. This is the dollar index. When the dollar index is moving like that, the
dollar has been stellar. Really. It's
the case of.
I have to say, the momentum keeps going, and it could continue for a while.
It's a case of the one-eyed man being the king, really, because all the other major
the blind leading the blind.
Exactly.
The one-eyed man leading the blind.
It's other central banks are not quite as hawkish as the Fed, but the Fed's hand is kind of being forced.
Let's just face it; they're not close to hawkish.
Exactly.
The
And
only central banks that have been relatively hawkish are the New Zealand, the Reserve Bank of New Zealand, the Reserve Bank of Australia, which actually did something a couple of weeks ago, which we mentioned. They have released control of the bond market, led the 2-year spike higher by 30% over, quite a short time. Anyway, back to the central banks that are hawkish. The third one is the Bank of England.
Yeah.
And that's not helping the pound yet, just because it's the rising COVID cases in Europe are pressuring
European currencies,
central banks to stay back. So that's not to say that it cannot happen in the US, considering the fact that last year we had a similar trend. Europe got hit first by a new wave, and then the US followed. And relatively warm weather in the US so far might have delayed their rise in COVID cases. Let's see if there is any meat to that, a point to consider.
Oh, well, look at the euro dollar. I mean, obviously Europe has it the worst in COVID, in terms of COVID, and the in Germany it's the worst that it's ever been in terms of infection rate, according to Angela Merkel, the Chancellor of Germany. And because of that, any bets that the ECB was going to tighten their belts a little bit, those bets have all been kind of withdrawn by the market, right? The market is no longer expecting the ECB to tighten policy anytime soon. Yes, it's probably going to end the PEP purchases program in March, but then thereafter, the ECB could continue with its existing stimulus programs for a long time in order to support the economy as it battles through the latest wave of infections and lockdowns. So against that backdrop, I wouldn't be surprised if the euro dollar were to go all the way to 110 from here. And something dramatic has to change from a macro point of view for me to turn bullish on euro dollar.
To change your view. Yeah, of course.
So right now it's just
what could change is at some point in time, if the stock market starts bleeding, the Fed will eventually blink. But how do you blink when inflation is at 6.2? I have no idea. So we're in this state of damned if you do, damned if you not raise interest rates. It's a very unique environment, and if from a political standpoint, it's very damaging to the current government to have inflation rates at these levels. So it would be unprudent, if there is such a term, for the US government to leave things as they are. Absolutely.
Speaking of European markets, the German 40, no longer the German 30 index, right? Is the DAX 40 now. It has broken down below this breakout area, which was previously resistance. We struggled to move away from that area for a few days, but then the market decided that the macro backdrop was still strong enough to sustain the breakout, and the market tested waters above this area for a few days, but ultimately couldn't hold there. And over the last few days, we've sold off, and the market has moved back below the point of origin of the breakout. So now the market would be testing. Okay, so we couldn't hold above. We've broken below. Now we're going to test this area again. Is there going to be acceptance below? And I think, judging by what's happened in global markets over the last few days and everything else, we've bounced from the lows today. I reckon it's going to be very difficult for the market to break through this black level right here, or this shaded region. So if you are trading the indices, perhaps keep an eye on the smaller time frames. The hourly here is testing that zone that I've highlighted in blue. And right now the DAX is testing that area. So if I were a betting man, I would say, and I am a betting man, I would say from here, the DAX is most likely going to head lower, because this was previously support. It's going to be very tough to break through it without a change in the macro backdrop. So I wouldn't be surprised if the DAX resumes lower from here after bouncing noticeably from the lows that were hit earlier this morning.
Right. So shall we have a look at other commodities like oil, for example? There's been there have been some rumors about a coordinated release of reserves on part of the US and some other countries. I don't know which ones do they envision spreading these rumors, but let's see. The market has been definitely impacted by the increased likelihood of lockdowns in some parts of the world, namely Europe. Would that be something that is going to last? We have no clue. Well, what we do have a clue about is that the crude oil market has rallied relentlessly over the past year and a half. So such long runs tend to experience violent corrections at some point in time.
It's always a bumpy road in the markets, isn't it? You never see a straight line unless you're talking about the Nasdaq. But yeah, for most markets, you usually get to see these kind of retracements inside the big uptrends. And oil still remains in an uptrend. Whether that changes, as Victor mentioned, we don't know. But what we do know is we've been calling for the market to drop when it was rising towards these levels, if you remember from our previous webinars. And there were so many reasons why we thought oil was going to go down. Mostly because of concerns about demand from emerging market countries rather. So,
and these concerns actually
materialized.
are starting to materialize only now when the dollar is actually taking off in a big way. So price pressures in terms of fuel costs are going to be felt by all emerging markets right about now. When when the dollar is pushing so much higher. So from a technical point of view, when oil broke the short-term bullish trend line, that's when the trend started to turn lower. We have since had a few lower lows and lower highs. So if you're trading oil, just remember that the path of least resistance is now to the downside, as we are approaching or testing some key technical levels. We did test a very key technical level in Brent, and I'm not so sure about US oil.
We'll have a look at it.
Switch over to that chart.
In a minute, I'll do. Let's have a look.
We have breached that support at 77, which was previously like the prices bounced from it before, just right after the breakout.
Mm.
And what is the pullback low from that breakout? Actually,
From
we
which
did
breakout?
test. Yeah,
This
that
one?
one. Yeah.
Okay.
So the pullback low at 75 is the key support level
75,
to
yeah.
look at in terms of US oil prices. So these are the levels to highlight in terms of oil.
Notice how one thing I love about crude oil is how it respects technical levels. If you look at this level, for example, we broke through it, and then here I know there was a slip. It slipped through it, but then on a daily closing basis, it held that level. Once we went above, look how nicely this level was tradable right here. Came very close to testing it before bouncing, and then once we broke it a few days ago with this bearish candle. The rally from yesterday came to a halt right at that level here, and it's resumed lower. You can see that more clearly on an intraday chart. But the point I'm making is, crude oil, I find it is very a very technically friendly market to trade. In case you're looking for new markets to trade. Here's another example of simple support turning into resistance. Here we have resistance turning support, and again before it finally breaks. And then look what happens here. Once this level breaks cleanly, retest offers a big drop.
Yeah.
And similar on the way up. For example, here we broke out, came back down, retest, massive move up. Here another level. If you allow me to elaborate a little bit on this, we had the high here, breakout, retest, boom. Very simple but very effective. Old resistance turning into support and vice versa. So if you are looking for new markets to add to your list of tradable markets, crude oil is one of those, in my view. So that brings us towards the end of the webinar and to the Q&A session. If you have any questions,
do you guys
now
have
is the
any
time.
questions? Something that we've missed that you want us to take a look at? Silver comes to mind, actually. Let's give our listeners a bit of time to ask their questions while looking at silver. So
Silver was
that 200-day moving average didn't give up.
No. We mentioned when it broke out from this bull flag that the target for us would be the 200-day moving average. And then it sold off from there. But then this shaded blue, gray area was where we were expecting the next move up to start from. It only offered us a little bit of a bounce when it tested this level right here. Can you see that? But then it broke down. So this is now going to be resistance area to watch. Where do you reckon we're going from here, Victor?
Can you switch over to my favorite monthly chart?
Sure.
I'll show you.
I have a feeling you're going to say something very bearish.
Oh yeah, you know me by now. I think we're going to test $20.
$20 looks very likely, doesn't it?
Yeah.
From this time frame.
Yeah. Well, yeah. From psychological standpoint, it seems like this would be the magnet that attracts the market towards it.
Yeah.
But overall, like, we have a technical support around 21 before then, which is the previous high in 2016. So that's something.
Which one did you say? The
2016 high,
16.
which is around 21.
Right.
Yeah. So this level is the first target, but ultimately I imagine that we're going to do a false break below that and bounce from 20, or perhaps even revisit 1950 or something like that. But
Right.
anyway.
While Victor was discussing those lower levels, something that caught my attention on this monthly time frame is this area here. Sorry, let me just. Yeah. Previously, on the monthly time frame, you can see that there was a false breakout attempt above this high. This is the last area of support that should have held right here when we came back to retest the zone. Then it broke down. We made a lower low below this low. So now it's coming up to retest this area of potential previous support, and now it's offering resistance. In addition to that, we had the inside bar candle on the monthly time frame in the previous month. We broke above the high of that candle earlier this month. The breakout should have held. So far, it hasn't, suggesting that the bulls that bought the breakout above the high of the candle are now trapped. Some of those guys will have placed their stops below the low of that monthly candle, namely below 22. And that's where the market could be heading down to, as Victor mentioned. So that would be the target,
just to clean out some stops and weak longs.
Yeah. Ultimately, $20. I reckon that, the 2016 high is going to be taken out as well. For me, somewhere around here would make more sense to look for fresh longs around. By the way, I'm not
19.
necessarily expecting the market to come all the way down here. I'm just saying if it does come down, then I'll be actively looking for long trades around these levels. What could happen is the market could turn around from here based on some unknown macro stimulus that we are not thinking right now. And go back positive on the month. And if that happens, then we'll go back to the daily chart and consider bullish setups above the shaded region once again and above the 200-day moving average. But for now, the possible resistances to the downside. We've broken the bullish trend line. It looks very likely that we'll go down to 23 next, the low from this candle, and possibly to the levels that Victor mentioned next. Why was gold rejected at 1877 is another question that has been asked. The reason it has been rejected at that particular level is we don't know. That's the honest answer.
No
one knows.
Is,
it's a macro, isn't it?
Like whether it was like the level doesn't really matter. What happened was that the market realized that the Fed might tighten policy faster than currently expected. We had two members of the Federal Reserve's Open Market Committee comment that they think that the current pace of tapering might not be sufficiently fast. So we're like, while Chairman Powell hasn't signaled anything like that, some members in the committee are thinking that they should start tightening monetary policy faster than currently has been signaled to the market. So that's something that the market didn't expect, and it's pricing it in. Whether it will happen, well, there is 2 or 3 weeks until the next Fed meeting. I think it was in mid-December. So that would be the point when we could see further clues from the Fed, what is going on, and whether they will be increasing the Fed of tapering, that is of asset sales, reduce their balance sheet in order to curtail inflation faster than they currently are doing. So the next Fed meeting is on the 14th and the 15th of December. I personally wouldn't expect many changes in current trends until about then.
Okay. I would like to add here a couple of things. Out of gold and silver, if any of them has a chance of coming back up, it's probably gold, because right now, we are in a kind of a risk-off environment for the stock markets, meaning that risk assets like silver and copper are not going to be doing very well, historically speaking. So gold is a safe haven asset, and if any of these metals has a good chance of a comeback, is probably gold. Another point is that out of the major currencies like the euro dollar, the pound dollar, all of these currencies, these fiat currencies, they're not going to protect you against inflation, because inflation is a global issue. So anyone switching to dollars from pounds and euros, they will be protected to some degree because of the exchange rate, but the actual purchasing power of their wealth is going to go down because of inflation. What could preserve your wealth is possibly gold, because gold is, gold is gold. It's a real asset, and we may see crypto investors, cryptocurrencies are selling off. Some of them may decide to buy physical things with it, like gold.
It's possible. If I were them, I would be doing that.
Yeah. So, gold has the best chance of a comeback against the dollar, in my view.
True.
Compared to any major currencies. Obviously, gold is not a currency, but if you view it like that, then.
Yeah, if there is any asset that is that can come back against the dollar, it would be gold.
Because inflation is a major issue right now, and if gold is considered to be the ultimate hedge against inflation, well, it needs to prove itself, and it needs to prove itself right here, right now, where we're testing.
There is of course another risk, which is stagflation. That's when the economy contracts and we have inflation. At that point in time, I don't think that gold can hold its current value, just because it wouldn't make sense to keep your money in gold while the economy is, in tatters and unlikely to,
So where would you, as an investor, then where would you park your funds in that environment?
In cash.
In cash,
certainly in cash, because I'll tell you the rationale. Like if eventually when we have stagflation, we're gonna have to get higher rates.
Right.
There is, like, historically there hasn't been a case when when.
I understand the logic behind higher rates and everything, but surely stagflation means by definition inflation, right? Inflation eroding the value of cash.
Real assets in terms of land, property that is still underappreciated. Is there anywhere in the world that the property market hasn't gone baloney? I don't know.
And what's the next
property at these levels either?
What is the next best thing to property? Because obviously not everyone can afford property, and not everyone can view property as being undervalued at these levels, because property prices have gone up across the world, especially in Western countries like UK, in the US, Canada, everywhere.
So obviously, like the best thing is, I still think higher margin tech companies, Apple, Google, all those super overvalued stocks. But the bet here is that eventually the Fed is going to come to the rescue, and you have to wait for in order. Well, as Warren Buffett said, be bold when others are fearful, be greedy when others are fearful, and fearful when others are greedy. So it's time to be fearful now. Fearful for me means cash.
Yeah.
I'm gonna become greedy once everybody starts panicking.
Excellent. Obviously, there's so many things that can happen from now until the next Fed meeting. So
As
keep
usual,
an eye on.
an infinity
Exactly.
of scenarios.
But right now, the dollar is the dominant theme, right? The dollar strength is the dominant theme. I wouldn't necessarily play the dollar strength against gold because of the reasons I mentioned. If you're bullish on the dollar, I would imagine the euro dollar. We already touched on the euro dollar, but the pound could be in trouble as well, because if the eurozone is not doing well, the UK is not going to be doing well either, because the eurozone is the largest trading partner of the UK.
If the eurozone catches a cold or COVID, the UK is gonna follow.
Yeah, if Germany sneezes, what's the saying?
If Germany sneezes, put on your masks.
Exactly. So that's why the pound is weakening as well against the dollar. And I reckon there's a good possibility now that we may revisit 130, or at least low 130s in the days ahead. We're not that far from it, 350 pips from there, but it's certainly a level where, judging by how price action has unfolded this year, and the Bank of England faffing about, we could be heading lower towards 130. So keep an eye on the pound. Elsewhere, I think the dollar Swiss is another one. It's been building. It's been building and building for several months. The trend has started to look positive now. The 200-day moving average is pointing higher. If you just concentrate on that, objectively telling you that the trend has turned positive, even though we haven't seen a major breakout from the consolidation that price has been stuck in over the last couple of years. But in line with all the other dollar pairs, I think the dollar Swiss is likely to break out above this area and head towards 95, possibly even parity over time. But that's a long way away from where we are at the moment. Right now, I think 95 is a area where the dollar Swiss may be heading up to. And I can't see any further questions from our live attendees today. So let me just quickly remind you then, for those of you who are watching a recording of this, that if you'd like to join us for the upcoming webinars, please do so by going to our website, go to market analysis and click on live webinars. Here you will see a schedule of live and upcoming webinars, and you can click on the register button to register for the next webinar. If you've liked this video, please also like and share, as this will encourage us to produce more content like this. Thank you so much for joining us, those of you who are here. I wish you have a wonderful week ahead. And thank you, Victor, as well, for always providing your insightful macro views. Really appreciate it. And I hope to see you again same time next Tuesday.
Happy trading. Stay safe.